I've mentioned the benefits of delaying a 25% tax-free lump sum in a few of my videos, and whilst that remains true, I've had a few people reach out, and during our conversation, it seems like it's a foregone conclusion that delaying or not taking the maximum 25% tax-free cash amount from your pension pot is always the right thing to do. This definitely is not always the case. So in this video, I want to talk about 5 reasons that you should take your full 25% tax-free lump sum right away, and in what situations delaying may not actually be the correct approach. So it feels right to start here, and that is the impact of Labour's recent tax changes. So for those of you that may have missed this element of the October budget, Labour plan on bringing pensions in scope for inheritance tax purposes from April 2027 onwards. Currently, pension pots that are left as part of someone's estate upon death are not subject to inheritance tax. So how does this affect the way that we interact with our pension pots, specifically the tax-free lump sum amount? Well, previously, alongside the 2 biggest considerations that you need to make when drawing down from your pension, being your financial needs and the tax efficiency of the drawdown, the estate planning implications, or in other words, what is most tax efficient from an inheritance tax perspective, would also need to be considered. For example, if you're considering taking a tax-free lump sum amount of 50k that say you wanted to hold on to as a sort of emergency fund within a savings account, you may previously have felt discouraged to do so. The implications to holding on to cash in this scenario is that you may not use it prior to your death and could easily then fall into your taxable estate. This is of course assuming that your entire estate is in excess of the 325k nil rate band. This money would then be subject to a 40% tax when passed on to, say, a child, meaning a £20,000 tax bill that was completely avoidable by just leaving this amount within your pension pot instead. Well, from 2027 onwards, this becomes a moot point. Your pension pot will be treated in the exact same way as cash savings, meaning that drawing down this amount to have it in, say, cash savings may actually be a viable option from a tax perspective as well as a personal needs perspective. There are a lot of examples like this, but the headline here is that the use of your pension funds no longer is likely to have a knock-on impact for inheritance tax purposes.
The Prime Minister has told this programme pensioners will be better off in the long term under Labour because of the tough decisions being taken by the government to stabilise the economy. Speaking at the end of the G20 summit in Brazil, Sir Keir Starmer defended the cut in winter fuel payments and said his priorities were investing in the NHS, schools and housing.
Number 2 is if your split between pension assets and other liquid assets is too uneven. What I mean by this is if once you hit retirement age, you have, say, a big defined contribution pension pot, but other than that, you have no funds within an ISA or your savings or any other readily available asset that you can draw down from, you may be handcuffing yourself a bit and therefore being very inflexible with how you access cash in retirement, and therefore also become inflexible with how you can tax plan and be tax efficient. For example, we're currently seeing tax thresholds be frozen year after year in the UK. That means that if you want a similar level of buying power each year, you'll have to withdraw more money in line with whatever the inflation rate was year on year. However, your personal allowance and income tax bands do not rise with inflation, so it's more than feasible to expect that you'll fall within a higher tax bracket in the years to come. Taking a tax-free lump sum and investing that within an ISA, for example, makes you far more flexible and, in the case of our example, gives us a source of income that is entirely tax-free, meaning that the potential for drifting into a higher tax bracket through this fiscal drag effect of tax band freezing is avoidable because remember, when drawing down from your pension pot, this is taxable income, whereas withdrawing from an income source like a ISA is entirely tax-free when you take the money out. Number 3 is risk, and not the risk that you may be thinking of, so let me explain. I'm very hesitant to delve into the more speculative side of tax policy, etc. But I'm sure we can all agree that the likelihood of the tax-free lump sum rules becoming more generous in the current climate is very unlikely. The current limit for the 25% tax-free lump sum is £268,275, which candidly is fairly generous. There was speculation that this may change in the recent October budget, which thankfully it didn't, but the fact remains that taking a tax-free lump sum now means that you have that money tax-free. And we're talking about big money here in many cases if, say, the tax-free lump sum rules were removed and that same amount of income then became taxable. Yes, it may not always be the most optimal in terms of growth opportunities of your pension pot, and sometimes may not even be the most tax efficient option over the long run, as letting your pension pot grow and then eventually drawing down a larger 25% tax-free amount is obviously more tax efficient when you look on a longer time horizon. But there is inherent risk to doing so in terms of the ever-changing tax environment in the UK. So for many, taking the maximum amount and having the opportunity to maybe drip feed some of it into an ISA each tax year, pay off mortgages or park it in savings, provides an immediate guaranteed benefit that outweighs the potential risk that future changes may represent. Next is the fact that having access to a lump sum of cash may represent a better return than the potential future growth that exists within your pension fund. An obvious one here is if you have an outstanding mortgage or any other high interest debt. If you're looking at a mortgage interest rate of say 4 to 5%, then taking this amount as a tax-free lump sum and just getting it paid off will oftentimes be a good move. As you approach retirement and your pension portfolio becomes more de-risked, or in other words, your default fund will begin selling off riskier assets such as equity positions and purchasing lower risk, lower return assets such as bonds, the average annual return decreases alongside, of course, the risk that your portfolio represents, normally giving you a rate of return between 4 and 7%, meaning that taking the guaranteed mortgage interest rate removal and of course the additional peace of mind that being debt-free has can be a good move in some instances. The other side of this, of course, is if you'd rather have a portion of this money that you control yourself and you can invest in maybe higher risk, higher reward equity positions. You could do this by withdrawing your 25% tax-free lump sum and investing it into a stocks and shares ISA where you dedicate that portion of assets to equity positions, and that would still represent growth that is completely tax-free due to it being housed within the ISA tax wrapper as opposed to the pension tax wrapper. And lastly, but most importantly, is to just enjoy your money. I don't have to go into detail here about how the potential for future ill health increases as you get older, but keeping this in mind is important when making these financial decisions because they are not just financial decisions. I can say as a chartered accountant that it's very easy to get lost in the numbers and trying to do absolutely everything you can to maximize the potential returns and tax efficiency to provide you with as much income as possible in retirement. And don't get me wrong, this is clearly incredibly important when planning your retirement in order to have a sustainable and good quality of life in retirement. But sometimes a line does need to be drawn and maybe accept that it's not necessarily the maximally financially efficient way of doing things, but taking a big chunk of tax-free cash so that you can enjoy it now when you're in good health is the best move. I recently made a video about why you should retire as soon as you can, and it explores other factors, including financial factors, about why you should do this as soon as possible. So please give it a watch if you're interested. Anyway, thank you all for watching. Please consider giving this video a like if you found it helpful, and I'll see you all in the next one.